You are live with CWN. It's the 19th of May, 2026, and welcome to a new show, Carbon Weekly News, CWN. I think there are a lot of good shows out there already. They are lead informant. There are things like CDR Policy Scoop, which I love. Shout to Sebastian and Eva. I also love Reversing Climate with Ross Kenyon. And I also love things like Carbon Exposure from René. Shout out to all of them. But I think there is a talk show just like CNN missing, and that's why I am starting Carbon Weekly News. Welcome to the first episode, and it's immediately a very, very packed episode. Let's look at today's lineup. First, I will talk a little bit about what happened over the last 7 days. There are things for ICVCM. There are some new stats out from MSCI around offtakes, and so on and so forth. So we've gone to a little bit of these news over the first 20 minutes. Then we have our first guest joining, Allister Furey, CEO and founder from Sylvera, one of the biggest rating agencies. And we're going to talk about our joint DAX40 report, where we analyzed the CSRD filings and also register logs on what German DAX40 companies actually published and what their board if published. After that, we go into another, I would say, news that was all over the media, which is CBAM, Carbon Border Adjustment Mechanism. And we have one of the experts on board, Dan Maleski from Redshaw Advisors, and he will talk us a little bit about what kind of potential impact this new update of CBAM will have on carbon markets. Fantastic. So you see when they will be joining, we're going to talk for 1 hour, and I will do this a weekly. So all the news, you will get it live every week at CWN. Let's get started. So first things first, let's talk a little bit about ICVCM. So as you know, ICVCM is currently going through all sorts of analysis and qualifications of different standards and methodologies, because basically what they're doing is they analyze on one hand the program, like for instance Vera, Global Carbon Council, Gold Standard, Isometric, and then the methodologies that live underneath, like for instance new red methodology or something VM42 for soil carbon. And they went on another round of different kind of analysis. And one update is that Global Carbon Council, GCC, which I think sits in Qatar, just got approved and is now CCP eligible. I think this is very interesting because so far all the programs that have been accepted are either in Europe, North America, or South America. So we see the first Asian program actually being accepted and being CCP eligible, which now enables them also look at the methodologies that live underneath. And they were also very, very exciting. So here they posted, so it's 6 days ago, that about it, Dr. Youssef Al-Hor, which is founding chairman of GCC, said, welcome this landmark recognition from the ICVCM, which affirms GCC standing as a high integrity carbon crediting program aligned with the most demanding global standards, including the ICVCM's core carbon principles and CORSIA. So that's the first news. I was a little bit surprised that other programs went in this batch. I thought, for instance, Carbono will also be part of this one. So I'm curious when the programs will either be accepted or not accepted. But just looking into what else happened. There is the VMR 17, which is only conditionally approved. So this is one of the renewable energy methodologies, we know that most of the renewable energy methodologies actually haven't existed. So that is definitely quite interesting that we see one actually being approved, but under conditions which are really rigid baselines and addressing the additionality and uncertainty. Then I think another one which I think is quite interesting, and yeah, I've seen a lot of chat about, is that the art trees methodology has not been approved, as there is remedial actions required in order for it to actually go through. What does that mean? What does that mean? There's already, I think, more than 50 million, I think it's like 54 million credits under the art trees, and especially around art 6 that will be very interesting. But that also means at this point none of them will be CCP approved, so they actually have to go back and see how they can satisfy ICVCM. Then we see Isometric, the mangrove restoration protocol got I think at the moment there are 3 projects under registered, not issuing yet, but registered under that methodology. So I'm really excited for that, because historically we hadn't had a lot of mangrove projects, and also I think it is not that easy to run a mangrove project, and then obviously around permanence it is quite a tough methodology to get right. So I'm excited for more mangrove projects on the market. Then we see another conditionally approved Vera method, which is around methane abatement. So I think overall, I'm always super excited when these new ICVCM announcements come out, and obviously there's a lot of work going into that. So yeah, I think we have to be patient, but I can't wait until the moment where everything, or most of it, has been analyzed by ICVCM. All right, let's look at the next point. So my next point is around MSCI. So I think this is a very, very interesting finding they just posted. And let me just give this a little more space. So what we actually see here is that MSCI looked a little bit into offtakes on the carbon markets, because we know that the spot market has been stagnating for a while now. I think it's between $1 and $2 billion yearly, but the offtake and the investment space actually has been increasing by quite a lot. They say $22 billion point to future carbon market demand, and this is a 72% increase in 2024, and more than 5 times of the 2020 levels. I think this is beyond exciting. Let's look a little bit deeper into it, because it is a trend we're also currently seeing. And you see here the graph. In green, you see the offtakes, and in blue, you see investments. You see offtakes going quite a bit. There is massive growth, and we see it's at 12.3 billion. And this is a completely different picture that we have to, but it is what we're seeing. We're seeing that companies more and more trying to lock in future offtakes, maybe because the credits that they want to buy are not on the market yet. Maybe because they think they have more, say, influence on the product itself. Maybe it's because they just get more benefits on the pricing, or they just want to hedge sorts of risks. So we think this is super exciting, and is what we're seeing also as a trend amongst the buyers. And I also find this interesting, where they talk about quality is a central driver of the shift. Only around 1/3 of available credits achieve a BBB rating or above under MSCI carbon project ratings, pointing to a limited pool of high integrity supply. Scrutiny increases. Corporates are moving to secure access to and take greater control over the projects that generate those credits. So I think this is extremely exciting. I also think this one is something we see a lot, is more 95% of carbon engineering projects and half of nature restoration projects achieve MSCI rating BBB and above, compared with global average of roughly 1/4. As a result, the average quality of future projects is likely to be materially higher than that currently in the market. So this is what we're seeing as well. They also say from transactions to commitments. So I think more and more companies shifting towards this model where past this market has really been spot-driven, but we see an offtake and forward-driven market is definitely the way to go. Okay. Fantastic. Let's go into the next topic. And this is something I've seen this week on LinkedIn, and I was just nodding along the whole time. So I thought I will definitely share this. So this is a post by Blangel, and he is talking about there is a missing demand driver for EU CRCF credits. So I don't know, CRCF is basically a new standard by the European Commission to get European carbon removals off the ground. And he is talking about why just doing or like building CRCF doesn't really help. And I was nodding along, I was saying, because he says it was not yet building a real removals policy architecture. Instead, it is mostly building later, hoping demand somehow falls. But unlike solar, wind, or batteries, carbon dioxide removal, CDR, a typical public good does not benefit from natural market demand. Its scale-up depends overwhelmingly on deliberate policy architecture, obligations, public procurement, and long-term certainty. The CRCF currently provides none of it. And I see it exactly the same way. Why? The first demand driver that was supposed to come was the Green Claims Directive. You know, we have the EMCO, the Empowering Consumer Directive. It is basically telling corporates in the EU what you're not allowed to do. So for instance, what kind of claims, green claims you're not allowed to make, what kind of other things, what kind of labels you're allowed to put on your product and so on. That's okay. But then there was supposed to be the Green Claims Directive, would have been a guideline on how to make these claims. And part of that was you are allowed to use CRCF credits for your claims, for instance, carbon neutrality or whatever. As this has been axed or like at least put on ice, the first demand driver is already gone. So we're building CRCF, which inherently is great, we need it, but we also need the demand drivers. So obviously, there's a EU ETS. I know a lot of people are meeting in Brussels week, and we're waiting for some more clarity over the next 1 or 2 months on how maybe CF credits can be implemented, EU ETS. But at the moment, we are not seeing these things fully. So I really like his view on it. So if you want to read a little bit more on it, there's a more detailed article that he published, which I only can encourage you to read through. So, as Allister from Sylvera is coming in a minute already, I will move over to our DAX40 report. And if you haven't seen it, jump to our webpage, go under reports, and you will see the whole thing. You can download it and you see all the things that I will share now in a bit. But basically what we wanted to do with the DAX40 report is that we, after the CSRD reports have been published, we wanted to analyze these based on the carbon credit reportings and filings under ESRS 127. And we also looked at the registries and looked what have these DAX40 companies publicly, transparently retired. And we actually thought this would be a very easy analysis. Everything will be in the CSRD and we don't have to do a lot. Well, it wasn't as easy as we thought it'd be. Why is that the case? So, first of all, we've realized that only a very small amount of companies published their exact carbon credit purchases in their reports. So you see this here. I'll make myself way smaller here. You see this here. Project disclosed more than 80%. We see only 6 companies have projects disclosed, and a part of them, I think 3 or so or 4, had to report in a Californian filing, and that's the reason they actually then also report, or we also found these projects. So we not only looked at CSRD, but also other transparency disclosure mechanisms. Then how many companies could we actually figure out their projects on the registries? You see, it's a little bit more. It's was it 7 different companies, but then it got less and less. But this is not about that we would analyze the DAX really well. It's more so that there was almost no data to analyze. So that's the reason most of these companies we couldn't really analyze on what is the quality of the credit they bought, how much removal, how many products in the EU. So that's the reason, unfortunately, our call is that CSRD is not made to bring a lot of transparency around carbon credits, unfortunately. And this should change, in my opinion. We also looked a little bit at some more things around the projects that we could analyze. Where are they actually coming from? They are coming from a couple of different countries. We see a massive amount coming from India. Then we 17 of the projects, all sorts, biochar, solar. Then from Rwanda, China, Uganda. You see a lot of them in Global South, and 4 of the projects are actually in Germany. If we then look further and see how did these projects that we actually could analyze, how did they look like? We see that a good amount of these projects were below BBB. And you see here exactly 57% below BBB, and the rest was actually above BBB. And I'm excited what Allister will say, how Germany coped initially. But I think this is very interesting. And we also saw that some company actually doing a great job. They have the tools. You can see they're doing a lot of things right, like for instance, SAP, Bayer, or BMW. So this is fantastic. I think the sad thing is really that more than half of all the DAX hasn't even participated in the market. So I think this is definitely something where we can make a lot of things better. And I'm excited now to talk with Allister about this topic a little bit more. Allister, welcome.
Hello.
How are you?
From a hotel room in Singapore, 20 past 10 at night here. So
appreciate you joining at this time of the day. Obviously, when I invited you, I thought you would be. So fantastic. Yeah, excited to talk to you quickly about our report. And I think let's jump right into it. I already gave the people a little bit of insight who is Allister actually. So maybe you can tell us a little bit just about Sylvera, and then maybe also a little bit this report and what are your, I would say, main insights, and we can dig a little bit deeper after that.
Awesome. Yeah, thanks so much, Adrian. It's been great to collaborate on this one. Hopefully my hotel room internet is going to hold up for the duration of this podcast. Just a word on Sylvera. So we're a data business. We provide data insights on the three themes, most known for carbon markets, spatial data, and more recently information on carbon intensity for industrial production. And we're known for assessing the carbon credits. That's where we started. And this is kind of, you touched on your introduction there, Adrian. I think similar conclusions with, you have 2 or 3 tails that pop out. I think the one to centralize is the positive one. Always the initial take from media tends to focus on the negative angle. I think the positive angle here is there are companies in the DAX40 who've basically solved this. Like, they are compensating for their emissions with credits that relate to high quality activities, and they're telling the world what they're doing. This is actually not that complicated. So they're doing the right thing, they're disclosing it, and they're using the tools available to them and doing a great job. So I think hopefully we can come back next year and say, 5 times that number are in that category. So I think, that's the positive story, right? It can easily be done. Everything is there, and maybe that kind of segues to the second one, which is like there are people that are doing taking sensible actions, and then just not telling the world about it. so that's a strange thing, and we would hope that would be a temporary state of the world, and that's almost because they want to do the right thing, but they're almost they fear the criticism that might attract. So I think once it's clear that it's easy for these actors to avoid the lower quality credits, then they should be comfortable in sharing what they've done, right? Why spend the money otherwise? And hide what you're doing, right? It makes no sense. So that's the next thing. And then the other 2 points are maybe, the ones that tend to get focused on, but I think it's important to say that they're solvable, like easily solvable now. People who are taking activity but buying credits that do not have the integrity that, frankly, the market is kind of centralizing much more on that high integrity end of the spectrum, and they haven't quite caught up. So you would hope that they would figure that out and kind of move along with the times. And then, like you say, the sad thing is, like, I think there's a kind of understanding now of the use of carbon credits as completely as like they represent a compensation for the emissions and then the climate impacts of those emissions, rather than a way of avoiding their emissions reductions internally in the supply chain, which actually has to be the priority for everyone. But yeah, half of these businesses haven't taken no action to compensate. So that, for some reason, doesn't attract the scandal of the people that are trying their best. But they're the kind of central stories of this report, right? So hopefully, as time passes, those will evolve. But that's where we are today, right? I think it's fair to say we've reflected the state of play right back on these 40 companies.
And do you think, if we look forward to a year, can that much change in a year? Is it easy for a company to actually look back and say like, hey, this is what we've done a year ago, but we understand it now. We've gone on that journey, and now we are able to do it in a way, I would say, aligned way with current standards like Oxford Principles or ICVM or ratings?
It's definitely possible. I think one thing, I'm sure you encounter this as well. Some actors, the reality is everybody in this market and on the net zero journey in general are doing things that haven't been done before. And therefore, there's always going to be learning and improvement because that's what happens when you do new things. So what you tend to see is there can be almost a fear factor to acknowledging that things in the past haven't been perfect. But actually, the whole market hasn't been perfect. Nobody is net zero. Nobody, probably very few people, even at an individual level, are on the right track to net zero. An extremely small number of are on the trajectory to be net zero. So it's fine to improve. But I do think I'd be actually curious to see if you hear this. Almost to do things differently requires you to admit that the things that have been done in the past haven't been perfect. But I think the thing that's changed is there's people like you that could help with the procurement. There's all these information sources. There's the academic guidance like you have for the so there are tools that the environment has changed, the resources have changed. So it's okay to change the strategy, but there is a little bit of like, if we do things differently, maybe we have to spend more money, maybe we have to buy less credits, maybe we have to acknowledge that the things in the past weren't perfect, and that can create almost like a drag on change.
Yeah, what I'm also seeing is a little bit of the almost a management problem, right? Someone was responsible to create the strategy for. Obviously, no one went to that market and said, we do whatever. I have no strategy. I think strategy is obviously also not done every year for the market, not for every company. So let's say a company has done the last strategy that's together 4 years, and someone came up with that strategy, but this person didn't have the tools. Now this person to come up and say like, look, it's not that I've done something wrong, but the market was not working really well. We have changed that strategy.
Exactly.
So that's what I'm seeing a lot. And I think there is some of inertia that we have to overcome, right? We have to say like, look, I did to my best knowledge 4 years ago what I've thought would have been the best strategy for us, but we have to readjust, and there's different things. And I think some people either are scared that then it would just cost way more, and then they have to hit like way high budget, because really often this sits in some kind of cost center, right? So that's what I'm seeing, that they say like they're scared when they not come up with a new strategy, then maybe or if they come up with a new strategy, then maybe it's cut completely because the budget is too high. And I also think this only can then work if we have those incentives, right? You were talking about like, are we doing this even? Am I not allowed to do a marketing claim? Why am I doing this actually? So it's going a lot back to incentives and making the right case internally why we should do this now and why you should get the budget now. And I think I agree on that every company can do that.
And I think what this shows, and I think again the positive aspect of it is hopefully the sustainability teams can say, hey, budget holder, exec team, do we want to be like these handful of leaders, or do we want to let the rest of that chart overtake us and or be just disappear off the chart? And usually when you speak to leadership level, they, their stakeholders, especially the asset owners, are still asking those questions, right? The long-term capital still cares. So typically at board and leadership level, they're going to say, well, look, are we going to, are our margins as a DAX40 business going to change if we make some compensation? And like the margins aren't really going to change. So then it makes it kind of easy, right? Yeah, we should compensate. If the cost's going to go up, you can apply some strategy that brings in higher proportion of removals, which is what the Oxford principle says. Anyway, you can bring in the higher price strategies over time as your decarbonisation plan. You can manage it, you can make those trade-offs and decisions, but typically the management team at the senior level tends to be pro. And like you say, I think there's a bit of a fear. Hey, if we share the best practice and the fact that it might cost more, the budget will go to zero. But we don't see that very often, actually, quite infrequently. Very rarely it does. I think it's probably worth mentioning that it has. But actually, even in those cases, we've seen those actors disappear for a couple of years and then come back again, because it just doesn't feel right to do nothing. Once you started doing nothing, it's like, what?
100%.
Do nothing? Like, it seems like kind of wrong, right? So they come back a couple of years later, but with a more sophisticated strategy.
Yeah, so I think you can implement that quite nicely in transition planning, especially the Oxford principles. What we've seen is that you actually don't have to spend that much more than old strategies that were reliant on a lot of renewable energy and cook stoves only. But I think if you start with Oxford, you probably don't even have to spend that much more, and then just have a ramp up phase towards your net zero. And I think we will see a lot of that. I may just switch gears a little bit. In the report, we had like 57% of the DAX40 projects were scored below BBB on Sylvera. Is this representative of the live market, or are the DAX40 buyers below or above the current curve? How do you see the German market on this extent?
This isn't markedly worse or better, I think, than the general mix. I think actually, if you'd done this a couple of years ago, the general mix would have been worse than this. So like, it's not a share of dollars, it's a share of credits. So tends to be, especially now, those lower rated credits. And why BBB? BBB is like halfway. If you're BBB or above, you're in the top half of the rating scale, and if you're BB or below, then you're in the bottom half. So there's a kind of an implicit threshold there. A couple of years ago, this would have been near 80% on a global basis. So this is okay. 57 doesn't sound great, but it's definitely an improvement on where the global mix was. And I don't think it's markedly different. If you were to look at,
is this a trend? Is a trend that in general the market goes more and more towards quality?
100%, and it's there's kind of a chicken and egg thing, which is and actually the history of Sylvera, and most people don't know, we tried to be a developer and failed.
Oh, is it? I didn't even know that.
Yeah, exactly. We tried to be a developer, and we wanted to do extremely high quality land restoration projects, native species, and we found ways of doing those for what at the time 2019 was extremely economically efficient. We had that lens. We were coming from a economic optimization, because I come from the renewables industry. It's extremely cost focused. It's like, we won't compromise on quality, we'll find the lowest cost. And even then, we couldn't get corporate off-takers to commit to buying the credits, and we needed that to finance the project activity at the price we needed, which at the time was around $15 for high quality nature-based removal, which now would be extremely cheap.
I would love that credit in my portfolio, but
you would sell out instantaneously.
100%.
And what we've seen now is the willingness to have this quality signal. The buyers are like, oh, now that I know that's what is the fair price, it's these these projects are not making huge profit margins. They're breaking even. They may be making enough to get a fair risk-adjusted rate of return if they're lucky. And the corporate might be like, yeah, I'm happy to pay $30 for a mangrove restoration credit, maybe $50, maybe more, maybe for biochar I'll pay again over 100, and that's reasonable. Now I know it represents the cost of that activity. I think in the past they were like, someone will sell me a credit from a eucalyptus monoculture in Brazil for or a Uruguay or something for $5. So why would I pay 15? Right? I don't understand. They're the same, aren't they? And it was impossible. So I think you have willingness to pay, and then people then come to the market and say, oh, that you're willing to pay $30. Well, I can do real, genuine activities on the ground for $30, and so then it brings supply in. So what you're seeing is the project, the older ones that had more compromised carbon out as they kind of expire and there's less demand, and then all the new, well, the majority of the new projects coming to market, much higher quality, serving this need. So you're seeing the shift. It's really, that's like the really great positive story. You're seeing hundreds of millions of dollars, and then you're looking for the investment, not just the spend on today's activity, billions of dollars, all going to things that are actually real, which is like what the market's supposed to do. And then that brings the confidence in, and then you're in the the 30, 35 odd, all but the handful in your report, and then if there's good supply, the price is reasonable. It's like, it's more expensive, maybe it's fair for the outcome, the climate outcome, and your peers are increasingly participating, and you're not on that list, and your board members like, oh, why weren't we on that list? We're not there, and then you start to get this change. So we should do this again, and like a year or two, and we test the theory.
No, definitely.
Like,
this will be a yearly report,
definitely.
Because I think one report is interesting, but I think if you have two, then you see what is actually happening in the world, right?
Definitely.
Because it's all about trends. If we see this is getting worse, then that wouldn't be good, right? So obviously, I hope we get better, but we should definitely do this, because just imagine, like, in 5 years we will look back and hopefully say, like, can you still remember 2026? That report was actually ridiculous. Think about it now, because we're on a completely different level. So I hope it will be like that. Also, you also have this these price indices on the webpage, right? You now also can correlate quality and ratings to prices, right? So for instance, more than BBB has a higher price than below BBB.
Yes, exactly. So there's we get prices shared to us, and we aggregate them and anonymize them. So we have over the years we've aggregated 200,000 prices. So we can have a pretty good view of what the price should be at any given time. And over really, we saw positive signs a couple of years ago, but from a statistical perspective, because we're kind of scientists under the hood, it's really in the last 18 months you've seen extremely strong statistically powerful signal that the ratings drive price premia, that's just reflecting the buyer preferences. So and there's this famous Nobel-winning economics paper called "Market for Lemons" by a guy called George Akerlof, and he basically says markets that have no information don't work well, and it gets all sorts of poor behavior. And his example is around used cars. The seller of the car knows if it's good or bad, but the buyer doesn't know. The buyer tends to assume that the car is bad, and the actor with the good car gets penalized, and the actor with the bad car gets rewarded. And this is why you have inspections and warranties, and why people pay the premium for the dealer approved, the brand approved used car, right? Because they've provided some level of assurance is worth maybe thousands of euros, thousands of dollars. So that's what we've seen. And honestly, at the beginning of the business, we were like, if within a few years the price doesn't, that the rating doesn't drive price, we'll just close the business, because it means that people don't have any utility from the data, and they don't believe the data. They don't think that it reflects reality. And then the good thing is, 2 or 3 years ago, we started to see the changing, but it wasn't powerful statistically. And as we got more data, we were like, oh wow. So now, for nature-based removals is a good example. There's a 330% premium between an A grade and a D grade. So
Wow.
so it's huge. And even when you have credits in a compliance market, like in the US for forestry management, there's still a 50% premium between the top and the bottom ratings. So even when you're submitting the credit and getting a tax discount, you still pay a small premium, even though you don't required. There's not required to. And 50% is actually not small. It's significant. So it's not that our ratings drive price. It's that our ratings have given the buyers information, and it turns out that they care about the quality of the credits and they're willing to pay more. so it's not the rating that's changed the thing. It's the ratings that have allowed the buyers to
100%.
show.
I also think we've seen that a lot of education had to go onto that, like educate the buyers on ratings, and I think we made huge progress over the last 1 to 2 years. Thanks so much for all the work you're doing with Sylvera, and then obviously also thank you so much for coming on to the show.
Pleasure.
Yeah, and enjoy your sleep in Singapore, and
Yes.
otherwise enjoy Singapore in general.
And hopefully we'll have a great follow-up show next year.
Okay. All right. See you, Allister. Have a good one.
Take care. Bye.
All right. Amazing. If you want to download our DAX40 report, just go to our webpage, www.senken.io, and you can download the report for free, and you see all the information that is included, that we just talked about, and also all the information that I shared before. So now we're going to switch a little bit to a different topic, which is maybe affecting the same or some of this kind of companies, but obviously is happening on a completely different level, which is CBAM, Carbon Border Adjustment Mechanism. And this actually was all over LinkedIn last week. I'm not sure if you also seen it. I can show some of the things that I've seen. So let me just do another one. So, for instance, one post, they all got an insane amount of likes. Big CBAM just dropped. The European Commission has published a draft implementing regulation on how carbon prices paid in third countries reduce CBAM certificate obligation, and it's a major step forward for global carbon markets. This is posted by Adam Herney. Key highlights from the draft: domestic carbon credits, offsets used under country or carbon tax, fully deductible with no extra EU quality hurdles, international carbon credits, only Article 6 credits allowed but capped at 10% of reported emission, and clear rules on calculating the effective carbon price paid. So, because I'm not the expert on CBAM, but it will have quite an impact on carbon markets, I'm extremely excited to have an expert on the show today, which is Dan from Redshaw Advisors. I'm so happy you could come on short notice. We were checking on Saturday, and then we just made it real quick, get Dan on the show. Can you maybe introduce you just quickly? How did you get into CBAM? What are you doing at Redshaw Advisors? And then we can jump right into.
Yeah, well, first of all, thank you very much for having me on, and it's wonderful to have another show. As we all appreciate, the carbon markets can be rather complex, and having some folks to break it down, and as I like to call, to take carbonese and speak English with it, is something I think the market definitely needs. So my name's Dan Maleski. I have the pleasure of leading the hedging and risk team here at Redshaw Advisors, focusing and helping companies interact with the costs that these global compliance carbon markets create. I find this quite an interesting space, the intersection between climate, trade, and finance coming together in an intersection. And well, right now that intersection is the CBAM. So more than happy to get into this and hopefully do my best to talk English today, not Carbonese.
No, that's fantastic. I'm German. My wife's South African, and talking English in general is already a challenge sometimes. But then talking English in carbon markets is definitely the next difficulty. So super excited. Can you maybe give us just a small, I would say, status quo? Are we with CBAM? And then also the next step is, why has everyone been posting the whole week about CBAM? What happened?
Yeah, and so the CBAM, the Carbon Border Adjustment Mechanism, is really just an extension of the EU ETS, Emissions Trading System. And due to the size of the EU ETS, any inherent demand that's created from this market, or indirectly via the CBAM, is of course going to get on people's radar. The EU ETS has almost a yearly traded volume of north of 6, 7, 800 billion US dollars. So it's in many sizes larger than global copper market, and it's a massive market. And so tapping into this demand is going to be quite of interest to, I'm sure, most of your audience, and in general, a lot of the efforts for climate change throughout the world. Now, recently, we've had some clarification on, specifically within the CBAM, what costs of carbon paid the European Commission might view as deductible under the regime. Now, I could sit here for about 3 hours explaining what that actually means, but principally, Europe is aware that it's not the only country on the block with the cost of carbon. And furthermore, within the CBAM, it's actually hoping to incentivize a lot of its trading partners to get these costs of carbon. And last week, exactly a week from today, exactly last Wednesday, we've finally got our hands on a long-awaited implementation act, which clarifies a lot of the groundwork on what costs specifically the European Commission would see as applicable, and of interest to, I'm sure, many on this event. Carbon credits came up a number of times. Now, that's not the first time we've seen carbon credits in CBAM legislation. Back in December 17th of 2025, Article 6 credits made their way into some of the proposed changes the Commission created. But this is a significant step in the right direction of potentially allowing mandatory ETS regimes, which allow carbon credits within that that market to be seen as a cost of carbon paid. And so that's going to be quite big news for a lot of countries that have an emissions trading system or carbon tax that allow a portion of the shortfall to be met with offsets. I mean, virtually most of the ETSs in the world allow some kind of offset, typically approved domestic offsets, but offsets nevertheless to be incorporated into that regime. So this is some great news for them, and potentially some good news for the wider VCM market as a new source of potential demand has been opened up.
Yeah, you just mentioned, and I talked about it all the way in the beginning, the current spot market and the VCM is like between 1 and 2 billion. And you just mentioned the EU ETS is somewhere 700 billion. Obviously, everyone's eyes and ears are opening up real quick. Could you talk us a little bit through, like, what could this mean volume-wise for markets? Is there like any kind of direction that we could look at?
Well, so if we're looking at this quantitatively, it'd be difficult for me to throw out any objective numbers, as these markets obviously are going to be very nuanced.
Yeah.
To give you an example, the EU ETS, we see a typical secondary market daily traded volume of between 15 to maybe 25 million tons. Now, the EU ETS, as it is a very liquid market and it is open to speculators. A lot of that
Yeah.
volume isn't just buying for compliance demand. It's the hedge funds and the bank buying and selling, readjusting their positions, which of course the exchanges like because it increases the traded volume. But it doesn't actually mean there's 20 million tons of EUAs every day being bought to use to compliance. And therefore, taking that reference of call it 700 million euros or dollars of traded volume isn't necessarily a good reference for CBAM, because unlike the EU ETS, which does allow and encourage in some regard speculators within that regime, there's no speculators for CBAM. The only people who will be exposed to CBAM are the importers. And the importers predominantly are going to be buying from your industrial sectors. And industry doesn't pollute anywhere near as much as power for most of these developing countries. And so if I look at the potential demand that CBAM could generate is, first of all, it's indirect demand, but second of all, it's going to be geared toward the industrials, not the power installations. And the power installations, even the EU ETS, but especially before we decarbonized significant back in 2005, call it, the vast majority of demand came from utilities. Furthermore, if I haven't lost anyone yet, I know we're going quite quick here. Furthermore, the changes to CBAM don't apply to CBAM authorized declarants. So don't actually apply to the European importers. It simply applies to the exporting domestic countries. Let's say I'm South Korea. I'm South Korea. I have all these steel mills within my jurisdiction that are exposed to the South Korean ETS. And so as a result of some of those steel mills potentially wanting to export to Europe, they are going to obviously want to ensure that the cost of carbon that they're paying in South Korea would be deemed as acceptable under CBAM. All CBAM is saying is, for South Korea's example specifically, because they allow some offsets, yes, it will. Now, the domino effect of that is that could incentivize further countries that don't have a robust cost of carbon yet to potentially be much more comfortable toying with the idea of incorporating carbon credits within the regime. So if we're looking at a direct demand, it's hard to pick a number because again, it's not the actual I mean, I could give you the numbers of the CBAM authorized declarants, but that's not necessarily what we're talking about demand-wise. Rather, it's the wider geopolitical element that CBAM is incentivizing and encouraging. That potentially could lead to demand. A lot of caveats within that, the incentivization of a treasury of a ministry, for example, wanting the revenue to go to a developer or auction allowances. And again, I could be here for an hour, but from a bird's eye perspective, that's where the low-hanging fruit could be if I was a project developer looking at the developments and what kind of demand it could potentially generate is that.
Now, it sounds fair. So it basically means, okay, we can't say how much, but obviously I think last week I talked to 10 German companies, and I think 8 of them, they're all directly impacted by CBAM. And obviously now there'll be a lot of different strategies going on. It gives them more flexibility, figuring out like how can, in the end, obviously for them it's about price. How can I pay the lowest price to still import this as part? But it will give them a lot of flexibility, if I'm right.
So the flexibility won't, and I completely appreciate that logic, and potentially, indirectly, it'll create flexibility, but it won't be the flexibility of the German importer. It'll be, let's say I'm a German importer buying my steel from Turkey or Egypt. The flexibility that this creates is actually for the Egyptian government or the Turkish government that now can be much more confident that if they create an ETS and that ETS has carbon credits within that mandatory regime, then CBAM would recognize it. Very simply speaking, CBAM is very strict on what they actually say is a cost of carbon. And the main principle is a cost of carbon has to be under a mandatory regime. So a legally binding carbon market, carbon tax that forces, let's say, a company in Turkey to pay for the greenhouse gases that they emit. That is the only cost of carbon that the European Commission deems as correct. So that the Turkish company can't just buy any VCM or even a CDR project and claim that as a cost of carbon. Europe's saying, sadly, no. Only under a mandatory regime. And this announcement is clarifying to those countries who can create these mandatory regimes what specific costs gives a thumbs up, and that thumbs up in this realm is certain criteria around carbon credits.
Okay, but if I understand this correctly, then this is one of the, to my knowledge, biggest incentives we've seen so far to harmonize global carbon markets, because
Yes.
other countries now have first time ever have a real incentive that comes from their own economy to set these
Yes.
markets. Oh wow, okay.
It
all makes sense.
The issue here is people do not appreciate how expensive carbon is in Europe. When we look at how much our clients are paying every year, it's going to boggle the mind if you're a South Korean or a Turkish cement company. I mean, a lot of them, truly, a lot of them are astonished with how expensive carbon is in Europe. Not just how expensive it is on the secondary exchange, but the net cost of it, so net of free allocation. And it's wonderful to talk about a harmonized cost of carbon, but if you look at the economics of that, you can't just snap your finger and have a cost of carbon. You're gonna bankrupt industry. They need a long runway. I mean, the EU ETS is at a runway for better half of 15, actually 20 years, and we're barely getting the position where industry is truly exposed. They've had time to ramp up investments and abate emissions, and so a harmonized cost of carbon is a wonderful idea, and I think that's where the runway is, the direction of the runway. But we have to also compare that and align that with the practicalities of industry, which is it moves slow and they need time to adjust.
That's fantastic. Now, the next question I have is just when I look at the different markets, like how do you actually get them harmonized? Because my thinking is the easiest example, and I thought I can remember that there were a lot of conversation was already when the EU ETS was talking with the UK ETS about linking up and then talking about what maybe potential CDR credits I could bring into the EU ETS and what kind of potential credits would be in the UK ETS. They are nature-based, but Europe only tech-based. How do you actually harmonize these? Is it possible or?
Well, there's a precedent, the EU in Switzerland. Australia tried doing it a while. The issue is we're not talking about policies. We're talking about markets. And when you get into the realm of markets, you appreciate how they act isn't something you can always control. There's all of these small questions we have to appreciate. What's the legal jurisdiction going to be? So let's say Turkey and the EU merge. What happens if a Turkish company does something incorrect? What court of law will they be tried under? Right? We get really minute into those elements, and it doesn't become a conversation not necessarily about policy. A wider conversation about markets occur. So, for example, when we had the ongoing UK and EU ETS linking conversation, I believe within the wider package they were talking about fishing rights, right? So it's much wider than just linking carbon markets. If it was that easy, we could do it. But all of these carbon markets are different. The EU and the UK ETS, they have a different linear reduction factor. The UK has a different has a floor price. They have all of these different small tweaks and small designs, and that's only the EU and the UK ETS. If we take a step back, we look at most of the carbon markets around the world. Most of them have a relative cap. The EU has an absolute cap. Most of them, they are very different if you actually open up the hood and look at them. If you look at the price on the exchange, you can just say, oh, why don't we combine them, create more liquidity? It doesn't work like that. It's much, much more nuanced. And that's why, I'll end it with this because I don't want to go over. That's why when we look at potential linking conversations between the EU and the UK, appreciate Brexit only happened a few years ago. Most of the analysts are expecting that to potentially occur by 2028, maybe 2029. And so what should, on surface be a quite simple, puzzle piece coming together, if you take a step back, you appreciate these are markets. These are very large financial markets. It's very difficult to actually incorporate them. So CBAM does create some urgency incentive for that, but again, from a practical perspective, it's quite hard to do.
So what does that mean for, let's say, corporate in Germany? Obviously, we're doing a lot of business in Germany, but also overall Europe. But let's just talk about the company in Germany. So these kind of new insights, because it's not like it's not actual law by now. These kind of new insights, they will have actually not that much impact on or like a corporate can't do a lot. It's more about probably prices that they will have to pay at the end that will change, or like how does a corporate in Germany need to think about these things?
A corporate in Germany needs to take a big old step back, and they have to look at what markets are they buying from. They have to look, if I'm buying steel, for example, I'm buying 1 ton of steel, could trade between, let's say, 600 euros to 700 euros. Right now, as a result of CBAM, if I buy my steel in Germany, depending on the type of steel, call it 600 euros. If I buy it from China, it's going to be maybe 700 euros. Because of CBAM. CBAM, as of a few months ago, added a 200 euro premium on it. So, and I'm broad brushing depending on the Chinese companies and default values, or you know, for the sake of me, CBAM is changing how you do business. It's changing who you're buying from, and this announcement now tells the Chinese government, hey, China, we will recognize that, you know, in China, it's CCERs, a portion of their total compliance that can be met with offsets. We will recognize that as CBAM applicable, which will then incentivize China to further potentially grow their cost of carbon, because the Chinese Bao Steel in China is going to be lobbying the Chinese government to say, hey, I'm losing business in Europe because my steel now has a 200 euro premium on it. I'm losing out to ThyssenKrupp in Europe. I'm not very happy with that. Please help me. And so it's creating this massive rise of global carbon. I mean, I could sit here for 10 minutes talking about all countries in the last 6 months have announced.
Never got so excited about
Oh, I love this stuff, you know. It's creating, it's really changing the wider strategic picture here. So if you're a company in Germany, take a step back. You will have to pay a significant cost of carbon if you import goods into Europe. You don't have, if you're not prepared, you know, if you're using default values, and then you have to look at how these policies are changing the host countries. We do a lot of stuff with private equity. If I'm a private equity company in Germany, where am I building my cement mill? Where am I building my steel? If I'm doing M&As, what steel company am I buying? And now part of the equation is what jurisdiction is that steel company in, and what carbon cost do they have? Because that is going to potentially impact the competitiveness that steel company has to the company in Germany. So the spider web here, it gets tangled very quickly. And again, I appreciate I'm probably broad brushing some of this because it's very nuanced, and it's hard to talk about the nuance with 5 minutes. But broadly speaking, that is the big picture.
Oh, I'm not kidding. I get excited about CBAM and the impact, and I wasn't aware of it, and that's always great, right? Maybe just before we close off, like does that mean on a timeline? So these new things that just came out, when can we expect them to translate into actual regulation?
Depends. I mean, if it's an implementing act, I'd say somewhere between H2 2026. We have, so CBAM is going to be changing constantly. I'd say basically every month for the next 8 months, I'd expect an announcement. We'd have, you know, we're going to see CBAM likely expand, you know, new sectors, you know, ceramics, refining. You know, just take organic chemicals, one of the sectors that is likely going to be included in CBAM. Adding one sector, organic chemicals, is going to completely double the CN code exposure of this regime. So we're going to expand horizontally with new sectors, expand vertically with downstream. We might get, you know, potential incorporation of new emissions. And so from a European Commission perspective and EU perspective, the policy is going to be changing. And then, as I'm talking about, we're going to see countries responding to you know. So if I'm a project developer in Brazil, the Brazilian government is now going to be looking at CBAM and saying, okay, let's get on our cost of carbon now, because we have clients in Brazil. What are they doing right now? They're lobbying the Brazilian government. And so you're going to see changes on both sides of the aisle. In the EU, via the actual CBAM legislation itself changing, and from responses from various trading partners.
So exciting. Dan, thank you so much for coming on CWN and for all the insights. It was really valuable. And yeah, I think then I have to get you on the show monthly because we have new CBAM.
I'm gonna put your audience to sleep. Yeah, CBAM is a lot sometimes. I don't blame you. It's EU policy. You know, no one wants to read a 77-page document, but sadly the devil's in the details. But nevertheless, pleasure to be on.
Thanks. Have a good one, huh? Bye.
Bye now.
That was the first episode of CWN. Please subscribe on Spotify. You will see the episodes coming up. Subscribe on Apple Podcast, on YouTube. And also you can join my bi-weekly newsletter where we're just I have a personal look to what's happening in carbon market, but just one specific topic every 2 weeks. Thank you much for coming and see you next Tuesday. Bye.